Hello, my name is Kyle Morse. This video is an application in financial intelligence based on the book Financial Intelligence for Entrepreneurs. I want to consider both the financial health of the companies I have chosen. I want to do this both to determine their prospects as a future employer and to better understand their baseline finances so I can make informed investment decisions. The two companies I am interested in are Nike and Hewlett-Packard. I am interested in Nike as a future employer since their goal of innovation for athletes closely matches my interests. I am interested in HP both because they are a downbeaten stock that may be worth investing in due to the price that is below their book value, and they come to the U of I career fair, making them a potential employer. The income statement is a statement of how much profit the company is making. It is basically sales minus expenses. At the top, there's revenues. Revenues minus the cost of sales or cost of goods sold equals the gross profit. Subtracting more expenses, including taxes and other selling and administrative expenses, results in the net income. The balance sheet shows what a company is worth based on the concept that assets equal liabilities plus equity. Or in other words, what you own equals what you owe plus your net worth. At the top are the assets. In the middle are the liabilities. Then at the bottom are the shareholders' equity. The cash flow statement shows how much cash a company has on hand for a given time period. It is the form of the least art, which is likely a reason Warren Buffett is so keen on using it to really understand potential investments. Ratios can bring light important aspects of companies' inner workings that are difficult to track just by reviewing the columns of data we saw in the previous three slides. Profitability ratios deal with profits. Leverage ratios reveal the use of debt. Liquidity ratios demonstrate a company's ability to pay the bills. Efficiency ratios track asset and liability conversion to equity. The first and most important ratio for entrepreneurs is the gross profit margin. This is sales minus the cost of goods sold divided by revenue. It shows basic profitability. Another way of looking at it is 1 minus the gross profit margin equals the amount of money you must spend to sell $1 of product. Return on equity equals the net profits divided by the shareholders' equity. This is important for investors. It can also be used to determine the sustainable growth rate for a company, as David Packard from Hewlett-Packard noted in a 1957 speech. The current ratio is equal to current assets divided by current liabilities. This ratio is called current because it deals with assets and liabilities considered for just 1 year. A current ratio close to 1 could run out of cash. However, if it is too high, that could indicate the company is not using cash well. When the inventory is subtracted from the current assets, the current ratio turns into the asset test. The ratios for the different companies show that Nike has a gross profit margin of 0.434, while HP's is half of that at about 0.23. Both companies have a similar return on equity, around 0.2, but the current ratio for Nike is almost 3, while HP's is barely above 1. Looking at the ratios, it is obvious that Nike is healthier in every category. While both companies have similar returns on equity, HP's current ratio is nearly at 1 and would not pass the acid test. Unless they are able to improve this ratio, they will begin to run out of cash. So while Nike appears to be healthy, HP is much more of a risk. There are three key financial concepts I'd like to note. First, numbers are based off assumptions in the various statements. Second, for really understanding how a company is doing, most investors prefer to use the balance sheet. However, Warren Buffett, one of the greatest investors in the world today, focuses on the cash statement since it provides the most unbiased picture of how a company is doing. Finally, companies use accrual-based accounting, not cash-based accounting as an individual does with a checking account.